Hi, all. Brian Manier here with Keystone Financial Group. Hope everybody is doing well. And I wanted to start out with the beginning of the year by giving some important 2025 tax updates. So I want to go through a few slides here, give you some important information that you need to know. And as always, you have the opportunity to schedule some time with us so that we can talk further about your specific situation. The first thing that I wanted to update everybody on was the updated ordinary income tax brackets. And here you see this specifically for married filing jointly. A little bit of increase in each one of these brackets, but here it is for married, and then also wanted to provide an update for those filing single households. So you can see married versus single, and then to put it within a picture, here is the married filing jointly. Sometimes a picture makes it a little bit easier to understand. Now, one of the things I like about this picture is you can see some of those big jumps, specifically from the 12 to 22 and the 24 to 32. What we always say is when we're working with our clients that these are some of the biggest areas for opportunities, whether these are Roth conversions or other specific things that we can implement in order to help you mitigate your taxes in the future. Now, when we're looking at taxes and we look specifically at the ordinary income brackets, it's important to understand that this is a progressive system, meaning if you're in, for example, the 22% tax bracket, not everything that you earn is taxed at ordinary income. So this would be relevant for things like IRAs, pensions, regular income. All of these would be taxed at ordinary income. So what you see here is if you make, let's say, $125,000, up to $23,800 is going to be taxed at 10%. Everything above that is going to be taxed at 12%, and then everything above $96,951 is going to be taxed at that 22% bracket. Again, very important to understand, to realize that not everything is going to be taxed at whatever bracket that you fall in. So whatever your last dollar of income is, that's the bracket that you are in, but it doesn't mean every dollar that you make is going to be taxed at that percentage. You can also see if you file single, how that would look specific to ordinary income. Now, I like this picture because this shows how the brackets work and what that means from your marginal brackets. I like this measuring cup because it gives a nice picture of what it means, the different income levels, both filing at a single rate or if you file married jointly. And you can see that each one of those increments, when it spills over into the next level, what that is actually going to mean as far as what you would owe percentage-wise from a tax percentage. Now, I want to call out the difference between where the tax bracket started when Trump went into office and they filed the Tax Cuts and Jobs Act compared to where the brackets are now. And what you can see is when you compare the two, whether it's the single tax brackets or the married filing jointly tax brackets, that regardless of where you were at on this chart, there was a reduction that you got once the new brackets occurred. So these particular brackets that were formulated back in 2017 are set to expire at the end of this year. Now, with Trump going into office, it's possible that these could be extended. There is discussion of whether they're extended. We don't know what or how long, or if it will stay the same. But it's important to just understand that if nothing is done, then the sale is going to end at the end of this year. We will keep you updated and let you know if things change, if there is new brackets that are going to be set for next year, or if these ones are going to be extended. But this year specifically, if it works for your personal situation, would be a good year to do any sort of tax management planning, because we know at the very least that the brackets are going to at least be tax favored for you unless the changes are extended. Now, I want to talk a little bit about capital gains. These are long-term capital gains brackets, so these will be specific for taxable accounts if you buy individual stocks, if you have mutual funds in a taxable account. What this is saying is when you sell those positions, whether you sell a stock for a gain, you're going to be taxed at a capital gain rate. So if you hold that position longer than a year, it's considered long-term capital gains, and you can see here on the chart what those brackets look like. That was for married. This is for single. And here is a picture like we showed earlier with the ordinary income. And I think these pictures do help because it gives you just a nice visual of what the brackets look like. Also want to talk a little bit about deductions. Specifically, what I want to call out is the standard deduction in 2025. It has increased to $15,000 per person. So if you're married, you have a standard deduction for the household of $30,000. And if you're 65 or older, you actually have an additional amount of standard deduction in relation to that as well. Next 6 things that you need to know for this year is for if you are 73 and you are now required to take RMD. So if you turn 73 this year, you don't have to take that required minimum distribution until April of next year. But if you wait to do that for next year, then you have to take another RMD at the end of the year. But these have been raised by the Secure Act. So if you are born in 1960 or later, your required minimum distribution is going to be 75. The required minimum distribution penalty was actually reduced from 50% to 25%. So it was a pretty considerable penalty if you didn't take that RMD. Another thing that you need to know is employer match for 401ks can be Roth after tax. Now, that's going to be up to the plan administrator. A lot of plan administrators are still not doing that, but there is that option. So if you are contributing to your 401k plan and you're doing the Roth option, just check to see if your employer can do it in a Roth format. A lot of times they won't, but it's good to just check to see if that availability is there. For this year, the IRA catch-up contribution, and this is specific for those that are ages between 60 and 63, is that this is again married, so you can do the greater catch-up between these ages of 10,000 or 150% of the regular amount. Also, starting last year, 529 plans can be rolled over into Roth IRAs. There's specific guidelines for that, but be aware that if you have kids and you had 529 plans and you didn't use all of the balance within there, let's say they got a scholarship or for whatever reason they didn't go to college, and those can't be passed within siblings for whatever reason, you have that balance, understand that can now be converted into a Roth IRA. There are specific rules for that, so you just have to know what those are. Also, another thing to just keep aware of, if you are self-employed, you can now do a simple Roth or a Roth SEP. And so these are new things that you should be aware of, and if it makes sense to implement those, that might be something that you want to consider as part of your plan. So as we look at taxes and we look at the tax management journey, as some of you, we've talked a little bit about this, is understand where we're at right now in our national debt. It is really high. We know we have a shortage of Social Security funds, Medicare funds, and so understanding what that might do to taxes long term. So what are the 2 things that the government can do? The federal government can either reduce spending or raise taxes. Well, it's not always favorable to reduce the spending. Maybe that is going to be true with some of the programs that are out there, but for a lot of things that are already implemented, difficult to just reduce that spending. The only other option that you have is to raise taxes. With that, that's important to understand if in the future taxes are going to be raised, what are some things that you can do in your own plan to mitigate those tax increases for you in the future. So what we want to talk a little bit about is for tax planning, what are some things that you can do? Well, one, you got to first be aware that taxes will more than likely increase. As we saw from the previous slide, and the size of the debt and some of the programs that we currently have right now, there's a shortage and some of these programs just aren't solvent. So think taxes are going to increase. Two, have excess room in your bracket. If you have excess room in your bracket and you remember the pictures that you just saw, especially between those opportunity brackets that we talked about, if you're in those brackets and you have room, then you have the opportunity. You are in a good place to do some of these tax management strategies that we talk to with our clients about. Sometimes you get a benefit from the greater deductions today. Sometimes it's better that you may not take those deductions and do some other strategies so that you get those tax savings later. I've always said that if you talk to someone like myself and then you talk to maybe your CPA, you may get two different recommendations depending on what you're trying to do. So if you're trying to get tax savings for the current year, that doesn't always mean that's going to help you mitigate those later on in the future. And then also you want to be concerned about planning for your spouse. So not just specifically for you, but what does that mean for you and your spouse, and how do you find those tax management savings? Those are things that we can talk through with you as we go through the tax management journey. So if you need to talk to us, if you have specific questions about your situation, if you're watching this and you want to hear a little bit more about what those brackets mean for you, what are some opportunities that you have, call Rose, email Rose. She'll be happy to schedule some time with us. As always, we really appreciate you and look forward to talking to you in the future. Thank you, everybody. Have a great day.